of, in perhaps US itself was about 4.5 million US dollars impact. If you look back at all the initiatives, centralizing payroll, controlling, if we had not done, we would ourselves be in a very different situation. And and in terms of the overall market, I think we do not see initiatives at scale being done like what we have tried to do over the last 2 years to meet the challenging environment. And that's why possibly the profitability, as Adarsh said, should be on a higher side compared to competition.
Oh, no, there is a question right there.
Yeah. Hello. Yeah, Advait from Equipoise Capital Management. Since you have explained your focus on digitalization, are you planning to move from 3PL player in logistics to 5PL logistic player?
Not yet, but you never know. If there's an opportunity, if you see the business makes sense, then obviously we would look at it. But for now, no. We want to focus on our core, and we continue to focus within those areas what we serve.
Sir, you have given the targets or the guidance for the next 5 years in terms of the top line and the EBITDA. Can you also tell what will be the capital employed and the profitability ratios which we can expect in year 2030? And the other question to the management is, what do you focus on? Do you focus on profitability or do you focus on growth? Because if you believe that, after you reach a certain size, then profitability will always, automatically follow, then that's a good strategy. But what's the target in the next 5 years? Thank you.
Yeah, so if you look at our business, it's completely asset light, and barring some investments in technology, there's no major capex, which means that essentially our capital employed will continue to remain flat. Maybe rather some of the historic assets would depreciate. So therefore our capital employed should remain same, and therefore the entire expansion on the EBIT should lead to an expanded return on capital employed. In terms of your question on what we focus on, I think the beauty of our business is that profit is an outcome, like I mentioned, of arbitrage between inflation and growth. So we always focuses on driving growth through initiatives. We're not looking at driving growth through, aggressive pricing or any of those initiatives. We are very conscious of that. We try to drive growth through all the initiatives which others spoke about. And when you drive growth and contain costs, that's the operating leverage that expands profitability in the best possible way.
Thank you.
Are there any more questions? If there are no more questions, shall we close the Q&A session? Okay. Thank you, gentlemen, and thank you to the audience for the questions. It was an engaging conversation. And with that, now, we turn our attention towards allcargo terminals, which facilitates trade through its pan-India presence of CFS and ICDs. May I invite the management team of allcargo terminals, starting with Mr. Suresh Kumar, Managing Director.
Good evening, everyone. After that very engaging session with our international supply chain, it is the turn of allcargo terminals, which is a CFS ICD business of the allcargo group. First of all, let me thank all of you for accepting our invitation to meet us today and hear the story of the group companies. Over the next 30-45 minutes, me and my colleagues will take you through the ATL journey. What is it that we have achieved over the past few years, and what is it that we have planned for the coming years? So starting with the first CFS in Navasheva in 2003, The CFS ICD business of the allcargo group has grown steadily to becoming a market leader in the CFS space. We have 7 facilities across 5 locations in the country, and these 5 locations kind of manage about 80% of India's EXIM trade. Out of these locations in which we are present, there is JNPA and Mundra, where we have 2 facilities each, given the fact that these are the 2 largest port clusters in the country. We have our other facilities in Dadri, which is an ICD, and we have got facilities in Chennai and in Calcutta. ATL at this point in time operates with about 230 acres of yard space across the facilities that I've mentioned. And we have got close to 1 million square feet of warehouses, which is a combination of bonded and general warehousing that we have. We handled about 6.79 lakh TUs in the last financial year. This is the laden volumes that we handled. Along with this, we also handled close to 3.5 lakh empty container movements, which is a critical part of EXIM trade, as you are aware of. We offer the full range of portside logistics services, right from transporting containers from the port to the CFS, stuffing, destuffing, customer-related work, special cargo, has cargo, the entire suite of services is what we handle. Over the past 20 years, we have built a very strong brand, and we are valued by our stakeholders for a bouquet of things. Firstly, for our pan-India presence. In an industry which is extremely fragmented, there are about 170 CFS players and about 45 odd ICD players in addition to that. We are one of the few operators who have got presence across multiple cities, and as I mentioned to you, we operate in ports which are handling about 80% of India's EXIM trade. We have synergies with the allcargo group, which gives us an opportunity to support the international supply chain in their LCL and FCL businesses. We have strong and deep shipping line relationships which help our customers. We are versatile when it comes to different operating models with which we work. For example, we have a SAMO operating model with CWC in Mundra. We have got a joint venture facility in Dadri with Concor. We operate landlord royalty-based lease models in JNPA, and therefore across the CFS spectrum, the different operating models is something that we are quite familiar with. We bring in our expertise into it, and we ensure that these partnerships are win-win for all stakeholders. Of course, the focus on ESG and sustainability, like our chairman spoke, this is something which is ingrained into the group. We do our bit on that front, and about 19% of our electricity consumption across the facilities is powered by solar. A quarter of our 3-ton forklifts are electric. All our facilities are ISO 9001, 14001, and 45001 certified. This is in the realms of safety, environment. These ISO certifications ensure that we are industry leading. We have been pioneers when it comes to various things in the CFS industry. Years back, we were the first to introduce RTGs in the CFS yards. We continue that tradition, and some of the latest things that we have done in this is we are the first to introduce digital enablement for EXIM cargo clearance. So we have got our app called MyCFS, backed by a portal to which access is given for our customers, and 2/3 of the entire EXIM cycle can actually be operated through the app or the portal without even visiting the CFS. So after we have launched this about 3 years back, there are a couple of others who have followed it, but we continue to set the standards in digitally enabling our customers to do the EXIM process. In the international supply chain presentation, you heard a lot about AI, which is something which is starting to touch every aspect of our business. So there is AI enablement that we have started to do with regard to cargo management by introducing tagless yard management, by which the containers are placed appropriately, stacked in a certain manner so that retrieval is possible. So this is something that we have piloted in one of our CFSs and will extend to others in due course of time. We have an experienced team, a small team of 355 people who are on roll, supported by about 2,000 associate team members. We have a gender diversity of about 9%, which is quite commendable in the logistics space in the country. And we have experience per team member, which is more than 10 years in the logistics space. I talked to you about the operations excellence in terms of the ISO certifications that we have. This is backed by stable vendor relationships and a vendor ecosystem which supports us to maintain an asset-light approach wherever we require in terms of transport, security, and equipment. The scale efficiencies that we have by operating multiple facilities come in and help us keep the costs lower. All this finally translates into great experience for our customers, and we have industry-leading net promoter scores of over 65%, and this has been consistent over the last 4 to 6 quarters. The other thing which our stakeholders value in us is our financial discipline. If we were to look at our balance sheet, it is strong. There is very minimal debt. We will talk about it as we go ahead. And we have a very efficient working capital management. Our DSOs are in the range of 15 to 16 days. In the last 3 years is something that I want to talk to you. The last 3 years, if you were to look at it, was preceded by COVID, and before that, the huge thing called DPD. So let me spend a couple of minutes talking about DPD, because in every forum that I have gone, the first question that comes my way when I say that I am part of CFS is the impact of DPD. So if all of you were to look at it, DPD started sometime in 17-18. It's a great move to ensure lower cost of logistics and a whole lot of other things which come along with it. We support it fully. But when it comes to DPD impacting the CFS business, we have JNPT, which operates currently at about 75% DPD. Chennai is at about 35-40 odd percent. Mundra is at a lower level. The addressable market or the addressable volumes which come into the CFSs haven't significantly been affected. This is simply because CFSs play a role in smoothing out what you would call freight rate hikes, which you saw in one of the earlier presentations, and the commodity prices. And therefore, customers see us as custodians of cargo for a certain period of time, and we also add value-added services to it. Therefore, the addressable market, which has been there for the CFSs, have grown at a steady clip, maybe a shade shorter than the overall container growth, but the addressable market continues to grow stronger, and we get our share of that. The other thing is, during COVID, when the overall supply chain systems across the world were severely affected, there was congestion in shipping lines, there was cargo which was piling up. I think India was a very good exception. Credit to all the good work which the various ports had done and the ecosystem had done. The small role which CFSs played in terms of evacuation of cargo was a critical thing which enabled that ports function smoothly. Therefore, our position with regard to DPD and the way in which CFSs progress is that CFSs are vital in the Indian port ecosystem. They are natural extensions of the port, and the value additions that we do for customers ensures that our addressable markets grows at a consistent pace. In that consistently growing addressable market, we have held our market share steadily between 12.5% and 13.5% over the last 8 to 12 quarters. We have kind of defied industry norms in a way as we have grown our EBITDA per TU consistently over the last 8 to 12 quarters. What was 1,800 rupees per TU EBITDA about 9 quarters back is currently running at about 2,100 to 2,150 rupees EBITDA per TU. This is on the back of a lot of efforts that we have done in cost optimization, yield management, and also ensuring that we do the right things when it comes to operations. We have transitioned from an asset-light model. When we listed about 3 years back, we talked about an asset-light model. As we continue to do business, we realized that there are strategic opportunities where we will have to invest directly. And we have done that, and we have a hybrid model of operations in which we use leased facilities in some of our locations, and we have also invested where it makes strategic sense. So some of the investments that we have done is in HORCL, which is the Haryana Orbital Rail Corporation. This gives us access to the dedicated freight corridor for the upcoming Farooq Nagar ICD, which we will talk to you about. Mundra is an extremely important market. We have been operating the 2 facilities within the Adani SEZ. As we look forward, we believe we need to create a larger facility, and therefore we have invested in land outside the Adani SEZ while the other 2 facilities continue. So this model of operations is asset right, which you heard our CFO also talk about. We completed acquisition of Speedy Multimodes. Speedy Multimodes is now a 100% subsidiary of All Cargo Terminals. We have renewed our contracts with CFS Mundra last year, and that gives us visibility till 2030. And we have recently enhanced our capacity in JNPT. So in summary, what we have done in the last 3 years is we have, as one of the front-running CFS organizations in the country, consistently run our business in a manner in which it delighted customers. Our capacity utilization is one of the best in the industry, and we are in a position now to scale up. So in terms of opportunity, I would now request my colleague Ashish to join me to kind of take you through the opportunity that we have. And from now on, some of the slides we will run together, because I think there are a lot of information that we would like to share, and it does better when we work together as a team here. So with regard to the opportunity, I'll just set the initial thing. So there is this graph which talks to you about the port volume growth in the country. So if you look at FY20 to FY25, 12.6 million TEUs is what we had in FY20. And this is now close to 20 million TEUs. And I'm talking about the ports in which ATL is operating. On top of this, there could be another 20% because we operate in ports which handle about 80% of our volumes. We expect the port volumes in the ports that we work in to grow to about 28 million in the coming 4 to 5 years. And there are multiple reasons why these volumes will grow. One is India is on the back of one of the strongest growth stories amongst the largest economies in the world. That drives EXIM volumes. There is capacity creation across the various terminals, which Ashish will talk to you. Ashish is the CEO of our organization.
Hi, thanks, Suresh. So Suresh has taken you to what All Cargo Terminal has been doing, and I think so that's a good flavor. Good to know that all these years we've never been in the red, we've always been green. So we are expanding and ever expanding story. I think so what we are also trying to say is the port expansion. So what's generally happening now is in the last, from 2020, and if we take it to 2030, we are already double the capacity of the terminal in India. So Nhava Sheva has just come up with its second phase of Port of Singapore, which has kind of enhanced and doubled the capacity of Nhava Sheva. Tuna Tekri, which is coming in Mundra, is going to come in with another capacity, adding to what Adani SEZ is already doing. What we are also heading towards is 2030, which is going to be Vadhavan Port. And I think so the story really defines post that. So in 10 years, India has not only kind of doubled, it's actually making it 3 times the capacity of the terminal. What does that mean to our business, right? So that's a connection that we're trying to bring in. With 2020, if you see the number, we were somewhere around 12.6 billion TEU capacity in the terminal. 2025, we are looking at 19.6, and 2030, we are going up to 27.5 million, and this is minus the Vadhavan port. Presently, where we stand with our facility, we are completely come to a situation where we are 85 to 90% capacity utilization. So what we're trying to do now is enhancing our capacity, and that's what our next plan is. So what are we expanding now? So JNPT, which is our flagship facilities, we are presently running 2 facilities out of here. What we've already done since last year to now, we've added another 25 acres of land parcel to our existing facility.
And we are also kind of redeveloping the Speedy facility, which is a 53-acre facility. So by redeveloping that facility, I think so we are coming up and we are increasing our market, our capacity over there. The second thing that we've done is what Suresh already mentioned, that we've taken about 60 acres of land, which is in Mundra. Now this is kind of not only going to grow our facility, but it's also kind of the location that we have brought in. It's in between Tuna Tekri and Adani SEZ. So what we are already trying to do is we're already trying to cover the kind of market that is going to start arising in Tuna Tekri. So that's a very interesting expansion that is coming up. Chennai, we have two terminals now. So one is like the Chennai port, the other coming, which is already now Kattupalli. We are now building capacity in Kattupalli. So the volume we see is increasing in Kattupalli, and we are already getting ready for that volume increase. And our biggest one is Faruk Nagar, which is going to be an ICD rail-linked, HORCL connected, and that's going to be the expansion that we're going to do in North India.
So these four projects kind of define what we intend to do over the next 3 years, and these are projects for which we have absolute visibility and that we are working on. Cumulative capex on this is about 400 crores. There's already investment of about 110 crores that we have done for HORCL and about another 35 odd crores that we have done for Mundra. So about 150 crores of investment we have already done. We will talk about investment and how we propose to fund this as we go ahead. Quickly on the capacity addition, what we intend doing, and this is a summary, FY25 we started at about 8.3 lakh capacity. CWC Mundra, we have done the renewal with an additional 10 acres, giving a 50,000 additional capacity. JNPT, Ashish just mentioned what we have done with regard to additional 25 acres. And the balance 3 blocks is what we need to do now. The Chennai new facility, Faruk Nagar and Mundra. That will take us to about 13.5 lakh capacity under our immediate visibility and control. I would also like to draw your attention to the fact that the asset right strategy that we are following helps us to acquire leased land, develop them quickly and increase capacity depending upon opportunities that we see. So in terms of capacity expansion, there is a clear blueprint that we have laid. And this blueprint rides on the India growth story, on the XM story. And therefore, we believe that there is a great opportunity that we are tapping into. I would just like to take you quickly through one of the opportunities to give you a flavor of what we are talking about, which is the Faruk Nagar opportunity, which is also the largest investment that we have amongst the 4 things that I have spoken to you. So the ICD opportunity in the NCR market, if we were to look at it, the market size is about 12.5 lakh TUs per year, and of which the addressable market size for CFS's ICDs is about 2.5 lakhs. The throughput capacity that we are building in Faruk Nagar is about 1,20,000 in terms of capacity. We expect to get to about 70% capacity utilization given the kind of industries in that area. So if you look at it, there are 2 other existing operators, but we bring in through the HORCL connectivity the unique advantage with lower transit times, which we estimate to be about 15 to 20% for transit from Mundra, from Faruk Nagar to Mundra, or whenever the DFC gets completed into JNPT. So that's a unique advantage that we offer. We have mapped the market there. We have met a whole host of customers who are in the auto parts, electronics, metal, pharma. There are a whole lot of industries which are there. There is a model electronic township which is coming up there. There is a lot of stuff which is happening in the NCR region, which is the gateway to the northern India market. And in the India growth story for 2030 and in the Vikasit Bharat growth story of 2047, North India is supposed to be the driver, and that is where we are positioning the Faruk Nagar ICD. So basis all this, what is it that we are aspiring for in FY30? Current volumes of 6.8 lakhs, we expect to hit 1 million laden volumes by FY30. Our revenues hover around 750 crores at this point in time. We would like to double that with the addition of capacity and the facilities that we talked about, and the EBITDA to be growing at a faster pace than revenue. And the asset-right approach that we spoke to you about, the geographic expansion, getting into northern India at this point in time, significant portion of our business interests are in west and in south. So we get a gateway into north with Farooq Nagar. That's also a rail-linked ICD. We will continue our commercial excellence and operational excellence, keep a sharp eye on digital enablement wherever it is possible, keep a sharp eye on costs, SG&A, and make the partnerships that we have run successful to reach the aspiration that we talk about. To run this aspiration, we have got a very capable management team, some of it the pictures are here, Ashish is here. I request Preetham to join me on stage. We will have question answers after this. So it's a very experienced team that we have, and we have divided our business into key regions. So there is a southern region, west, which comprises of JNP and Mundra, and then there is a north and east, which is handled by 3 regional heads that we have. And then you have the HR, the operations head, and the finance head. So 3 of us are here. With that, we come to an end of what we wanted to share with you. And thank you for patiently listening to us. And we turn it over to you, and we would like to hear from you what you think about what we said and any questions or clarifications that you may have.
Our hostesses are ready with the mic. In case you have any questions, please raise your hand. We already have the first question.
This question is to the CFO. I read somewhere that there is a 685 crores of contingent liability. Can you elaborate on that?
Major portion of 685 crore contingent liability is on account of port guarantees and bonds which we have to give to the customs and various port authority as a part of doing business. The real contingent liability in terms of claims and the tax related issues stand only in the range of 30 crores plus 5 crores of customer dispute. Rest all the portion of contingent liabilities which we disclose are part of bank guarantees and bonds which are considered in the normal in case of CFS and ICD business.
So it's only 35 crores, which is a possibility of not...
These are, I will say, income tax disputes plus customer claims which are again normal business cases.
So I'll just add over here. What you read 685. So actually, when you're running a CFS business, we have to give a custom bond. That is basically a part of business, and not only allcargo. I think so. All the CFSs, ICDs are linked with customs. It's a bond that we are giving, which is being retrieved as a liability. It's not an actual liability on us.
Thank you.
Hello. Hey, hi. So in the last con call, you mentioned that due to DFC, you have started to see throughput increase due to faster turnaround time. So cargo handling and cargo transportation revenue, will it increase? And how much revenue the company earns from handling the cargo versus warehousing the cargo?
Yeah, I think, let me clarify, let me try to understand what you're asking. There are 2 portions of the things that I mentioned. So one is the Farooq Nagar, which is a future that we are talking about, which is a rail-linked ICD, and maybe that is what you're referring to. Is my understanding right?
It's related to CFS.
The current operations?
Yeah, the current.
Okay, so the current operations, if we were to look at it, the revenue model of import-export that we have ground rent, we have handling charges, then the value-added work that we do. These are the things that we do for the customers. Ground rent, which used to be a larger portion of our revenue, has shrunk to possibly about 15%. And rest of the revenue that we get is on account of transportation and the value-added service that we do, plus the work that we do with regard to stuffing, de-stuffing of cargo. If that were to kind of answer your question.
So again, I'll add over here. So what when we say like our revenue, right? So if you see what we've just mentioned, like the capacity of the terminal increasing, what has not happened in Nhava Sheva is like the capacity of CFS and container freight station has not increased. So if you see what has happened in the last 10 years, there has not been any additional CFS or a land that has